assets are the answers to your financial success. At least that is in combination with a financial literacy. So today you're going to learn something. You're going to learn something that I wish I learned, honestly, right from the get-go. But if I even learned it, 10, 15 years ago, I would have been significantly in a better financial position, probably 10, 15, maybe even 20x of what I am right now. And this is information that is typically passed down from generation to generation of traditionally older money or just people, managing significant amounts of wealth. And really until recently, I think many people didn't even have it on the tip of their tongue of why to learn this. I think in 2020, the event from COVID and the resulting massive inflationary spiral that resulted, it was, a wake-up call for many. And that's where I started to actually look into this stuff, started to learn. And I want to say right at the outset that all of the tactics that we're going to be going over in this video, anyone could do them regardless of your financial level. You just need some sort of income, whether it be $1 or $1 million. You need some sort of an income, then you can apply these tactics. And I really, really want to be super clear in stating this. Look, I really don't think that the system, at least in the Western world, is rigged or it's a scam or it's I don't know, some sort of just nonsense. It is completely 100% transparent. It's just hidden below thousands and thousands of pages of legal and tax code, which no one will fucking read, but it is actually out there for anyone who does want to read it. I've been spending a lot of time reading it myself with the help of ChatGPT. And again, I've been studying this stuff now for about 5 years, I'd say. And this is what I wish I knew. And this is hopefully going to be as useful to you as possible. And this is effectively a, intro to financial education. So let's get into it here with a picture that I think many people can relate to. It is a man who is not walking even on a treadmill. No, he's walking on the financial treadmill of peace is what I like to call it. And the problem with this treadmill is that you feel like you are continually walking and walking and walking, expending this energy to get the money bag, as you can see right there, but you don't really feel like you're getting anywhere. In fact, you really aren't getting anywhere, at least tangible or at least equal to the effort that you are expending. And this issue really is because of, a misunderstanding or just a lack of financial knowledge. Now, we in the crypto space, which you're probably watching this video because you're from, my general channel's videos, you're probably aware of crypto, and you're probably aware of this issue, but it is very paramount to understand why holding assets is the answer to your financial situation. And that first comes from understanding inflation. Inflation, many people now have a deep experience with because of the resulting situation after the 2020 Rona period. Inflation was running rampant. We saw it get all the way up to like 8-9% CPI, which is probably realistically like double that, maybe even a little bit more for the real inflation. But that eats into the purchasing power of your fiat currencies, aka dollars or euros or whatever the hell you use. Anyways, holding that fiat currency makes you subject to inflation, which by definition just erodes the purchasing power of your fiat currencies each and every second that passes by. It is becoming a little bit less and a little bit less effective. We'll actually go in the next slide over a very quick calculation of, how quickly it does erode. But this was really the crux of the issue that I did not understand. I just thought, no, I'll just make more money. I'll just make more money. All good. That's amazing. But one of the easiest ways that you can, get off that damn treadmill and actually start making some ground when you actually expend effort is by first understanding this fact of fiat currencies, and then second, understanding the solution is assets. And again, I just really want to highlight here, prioritizing ownership of wealth building assets is the key. Do not keep any wealth stored in fiat currency beyond immediate needs. And we'll actually go over a tactic later on in this video, and I'll expand upon it in extreme detail in a following video on its complete own, about how you actually don't even necessarily need to do that. You can get liquidity, you can get cash without actually having to, really own fiat. In a way, you have to own assets, basically. Anyways, moving on, just want to show a quick calculation of inflation and how dastardly it is. And you can see quite easily here, I think, even in just 5 years at a relatively low CPI of 3%, we don't think of 3% as much, you're already going to lose close to 14% of your purchasing power. In 10 years, you lose 25% or more than 25% of your purchasing power. In 20 years, you've almost lost half. You've almost lost half of the purchasing power. So if you had $100 in today and you fast forward 20 years from now, that $100 has a purchasing power of about $55 or a little bit above $55. Now, this again is with, just your regular headline CPI data. That's typically a number that we want to be around about 2%, or historically that is considered normal. But realistically, the calculation of CPI is not so relevant, let's say, to probably most people, because it's a basket of goods that is continually manipulated. Like they put things in the basket of goods and they take things out and, then they mix them all about and they do the fucking hokey pokey and somehow it gets closer and closer to 2%. But realistically, your real inflation, which includes all the stuff that you're, interested in for your at least day-to-day life, that inflation rate is probably around double whatever the headline CPI is. Again, I'm just taking kind of like a very general assumption here, but if you go to trueflation.com, they have their own metrics for figuring this out, and you'll see that the CPI numbers are definitely on the lower side, let's say. So you could probably double this for the inflation average, and then also double this as well for the compounding of losing your purchasing power. So that goes down real fast. So then we need to answer the question of what are assets, because that's going to be our main key ingredient to fighting this inflation and to actually building wealth and putting ourselves in a stronger financial position, perhaps even becoming a part of the elusive lizard shadow council of the world, which everyone likes to talk shit about the Illuminati, but deep down, we all want to join. We all want to join, and you can join. You just need to understand this. I'm gonna take a sip of this water while you marinate on this picture right here. And this, of course, is a picture of someone putting money in their pocket. That's effectively what assets are. Now, this definition is being kind of ripped from Robert Kiyosaki, the author of Rich Dad, Poor Dad. Now, I don't have great thoughts about him as a person, I guess. Or, I mean, I don't really know him, obviously, but as his book, I absolutely loved. He kind of has become the boy who cried wolf with like the next crash. Anyways, on to the actual topic at hand. What are assets? Assets in the prior picture is just basically anything that you own that produces income or accretes in value, goes up in value, puts money in your pocket, basically. So, example of assets, stocks are the most easily understood one, or of course, rental properties, real estate. Now, these would have to be high conviction equities because, of course, some stocks can indeed and definitely do go down over time. Those can be more of liabilities, of course, but bonds are another example. You could own a business that, of course, must have cash flow. That would be considered an asset. Productized knowledge. This would be knowledge that you invested in. So, let's say you went to university and you studied law and you became a lawyer. That would be an example of productized knowledge. Now, you can also do that the wrong way. You could also go to university and major in underwater basket weaving or some shit like that. Probably going to be more of a liability if we're honest with ourselves. Bitcoin, of course, most people know that from this channel. Attention, if you have a brand, an audience, content, these sorts of things could be considered an asset. Elsa's yelling in the background. I don't know why. But more importantly, yes, with attention, you can sell your community stuff. You can put advertisements on your stuff. These sorts of things. That makes it an asset. Its ability to produce income. Software, licensable IP, relationships with high leverage people, not like with your fucking best friend who's a drug dealer or something. Obviously pulling some personal examples here. No kidding. Your reputation can be its digital capital. Your health, in my opinion, definitely is, because why? Well, if you prioritize your wealth, if you are in a good, healthy position, then guess what? Your mind and your body, physiologically and psychologically, you're going to be at the highest, operating at the highest level, which is in turn going to give you the most potential to generate income. So in other words, assets put money in your pocket or increase your potential to do so. Let's go over some things that are not assets. These are typically things that a lot of them are things that people think are assets that might go down on your balance sheet as assets, but they are not indeed assets in the way that we are defining it here. So these are basically things that are expected to go down in value or just cost you, basically. Cars, especially exotic luxury cars, these things lose value incredibly fast. It's not a fucking asset. It's not producing you income. Yes, you do it. You do Uber with it, maybe. But if you ain't making more than it is taking out, it ain't an asset, and very few people can probably say that that is the case. Startup businesses, again, must generate income. So if you're a startup business, you don't have an asset yet. Could turn into one later on, though. Life insurance, furniture, obviously always going to be going down. Jewelry, watches. I know people always say, but you just have to buy the right ones, and then it's an asset, and then it goes up in value. First off, it's not going to go up that much in value. I can already assure you of that. Second off, for the most part, for the overwhelming majority, no, it only goes down. I have personal experience with this. It's not fucking good. It's also highly illiquid as well. So if you really do need to sell it, it's going to be hard. College education, again, if it doesn't lead directly to increasing your income potential. Timeshares, NFTs, shitcoins, kind of, but really most of them are. So here's really why assets are so important. I understand this is kind of a little more of the boring part, but we do need to set the groundwork for the rest of this presentation in order for it to make the most sense, so that you can actually act on these opportunities. So assets flip the script from labor to leverage. So if you're not holding assets, then you are holding responsibility. That is a liability, basically. And without assets, you trade your time, which is limited. It is finite, for money, which is unlimited. I mean, for one, the central banks can just print as much of it as they want. I mean, that quite literally is what inflation is. And whenever some sort of political thing happens and you need money, they're going to turn on the money printer. They're not going to let the system blow up, obviously. And of course, that puts you on a staircase with a shallow ceiling. It basically, it relates your income earning potential to the amount of time you can directly work. So if you're even a high income earner, like a lawyer or doctor who's, making, I don't know, $500 an hour. I don't know what it is. Just, I'm going to assume that's somewhere around there. You can still only work so many hours in a day or only so many hours in a year. So it is limited to that. You have no leverage on top of that. Assets, on the other hand, make you anti-fragile. You're no longer dependent on a job, client, government, these sort of things, and they work 24/7, whereas you do not. Your corns, your bitcoins, your stocks, your bonds even are appreciating while you eat. Well, your bonds aren't appreciating, but they are giving you some sort of return. And they're doing that while you eat. You rest or you train. You don't have to be directly involved in the actual work to be getting the value from that. Assets are transferable, your labor isn't, and assets let you build a financial moat around your financial castle. They buy you time, energy, and opportunities, in other words. Okay, so what makes a good asset good? The core trait of an asset is its ability to produce income. That is key. Thus, assets may be compared on their relative ability to produce value or income, and assets can be best compared with the metric known as CAGR. We'll just call it CAGR, CAGR, which is, or stands for, compound annual growth rate. That's what we use to measure the growth rate over time of an asset, to then compare it versus another asset and decide, which one is a better investment over, a long period of time. So for example, you invest $10,000 and it grows to $16,105 over 5 years. What is a CAGR? Well, if we were to do the calculations on that, that's going to be about a 10% per year on average, CAGR compounded, of course. So again, even from this perspective, like it multiplies very, very fast. $10,000 to over $16,000 in 5 years. I mean, that's more than a 50% gain in 5 years. In fact, that's like a 61% gain, 6105 gain, something like that. It goes up fast. 10% is kind of what's considered normal-ish for traditional markets, by the way. So that's a good one to generally mark things off of, benchmark off of. An asset that has 30% CAGR, which is what many people think Bitcoin has, for example, is more preferable to an asset that has a 20% CAGR, and so on and so forth. Higher equals better. Of course, you probably should be getting a little bit skeptical when you start to see it get to astronomical levels. That's probably just due to the asset itself that you are looking at being relatively new, but generally higher equals better in terms of asset performance. So let's go through a few examples of common assets and their associated CAGRs. SPX, just your general average run-of-the-mill investment in the stock market is going to be about 10% year over year. Again, sometimes a little bit more, sometimes a little bit less, but 10%, still pretty good. I mean, as you just saw, around 10%, like you're multiplying things pretty fucking quickly. That's 60% in 5 years. Like, not bad. 5 years is not a long time. Not a long time at all. And I need to take another sip of this. NASDAQ, a little bit more. Tech sector has just been better recently. It's been better since it's really been born, I suppose, but that's a little bit higher, 12 to 15%. But even as we just went over, small increases in the CAGR percent equate to massive differences in accrued value over time. Bonds, if we're looking at a 10-year, it's traditionally around like a 5 to 6% CAGR. Again, not the best investment, but you're probably going to be at least keeping pace with inflation there, hopefully. Hopefully. Real estate, residential. So if you are living in your place, very, very low CAGR. Maybe you're just barely breaking even versus inflation. That's about 3.5 to 4.2% CAGR traditionally. If you're talking about rental real estate, however, that can be closer to SPX returns, 8 to 12%. Generally, business degree from university. Obviously, this is highly variable, but according to the internet, about 5 to 7% CAGR can be a liability. Obviously, in fact, probably is more of a liability nowadays. Sociology, like for example, if you have a sociology degree, that's going to be a negative 10% CAGR to maybe 1% CAGR. So not very good. If you buy a new Lambo, negative 15 to negative 30% CAGR. So very bad, very, very bad. Losing about half of the value of the asset, within a few years, maybe. Designer clothes, negative 50 to 100% CAGR. Like they just lose value, obviously, the second that you wear them. And then Bitcoin right here, at least Michael Saylor believes that it is about a 30% CAGR. So that is like pretty fucking good. I mean, that puts it head and shoulders above everything else. Whether you consider Bitcoin a safe investment or not, that would probably be the deciding factor. But 30% pretty fucking good. And again, comparing that versus, I would say, reasonably similar sort of risk profiles, I understand that you can absolutely demolish my statement right there. But, looking at it versus, your general stonks like NASDAQ, like SPY, much better, in fact. So quite good. You can even just see, even if this is perhaps a fleeting CAGR, which actually has been higher in the past, by the way, even if it's just fleeting for a little bit, like still those gains do add up very quickly. Anyways, moving on. Reasons to hold cash. So first off, the reason is to have three hands. I posted this picture on Twitter and someone was like, dude, I know that this is AI because his third hand only has 4 fingers. I'm like, very perceptive. Anyways, and it's very true. It is AI. Anyways, reasons to hold cash. So of course, we do need cash to live our day-to-day lives. We can't just hold all of our wealth in fucking SPY or SPX, for example, and then how do we buy our fucking daily ground beef or whatever the hell you want to eat? Well, you need to hold a little bit of cash. Now, cash, of course, on its own has 0 returns, unless you're in T-bills or money markets, these sort of things. Very, very small returns there, but there is a little bit of returns. Maybe it just barely keeps pace with inflation, or maybe just slightly outpaces or just slightly loses value. But it ain't much. It ain't much to my point. Inflation is guaranteed to compound the negative return of holding cash. Of course, we already know that. Anytime that we hold cash, the value of its purchasing power is going down over time. And that brings a question, when and why should we be holding cash? Well, of course, short-term liquidity needs. So that would be like an emergency fund, opportunity fund. Again, just buying like your day-to-day groceries, expenses, these sorts of things. Also, another reason to hold at least some cash would be to have a strategic cash position during periods of overvaluation or high volatility. Like let's say, for example, today stock market or SPX is trading at 10,000 and tomorrow is trading at 5,000. Well, it would be really nice to have a little bit of cash on hand for when it drops off that much so that I can go put it to work. take advantage of that capitalistic opportunity. And then, of course, you could put them in high yield treasuries. I mean, I think this is certainly not the best investment, but you could put it there. You get a little bit of return, I suppose. But in my experience, it is really best to minimize idle cash beyond 1 year of living expenses and emergency years. Some people say 6 months, some people say 3 months, some people say, a couple years, whatever you're comfortable with, that's about right for you. You can park all of that cash, by the way, or most of it in short-term T-bills or money markets. So at least you can get fast liquidity if you need, and it's earning at least some return. Yes, it's going to be a small return, but you can earn some return at least like you're not, eroding it away to inflation. So that's your first easy tactic to employ. Anyone can do this. You can put in $1 into a money market. You can put in 10, you can put in 100, you can put in a million, it's highly, 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 highly liquid. And when you do need to pull out your money, you have a Vanguard account, for example, maybe like a 1 to 3 day turnaround. Very simple once you actually need it. In fact, in many cases, brokers will actually give you some, sort of a card to actually access that liquidity. But yeah, topic for another video, perhaps. Anyways. Yes, so parking them in short-term T-bills or money markets is ideal. If you really need to hold cash, you can still do that and use that as like a sort of emergency fund, because you will be able to get that like pretty damn quickly, and it's pretty damn safe as well. And again, does at least keep you pace typically with inflation. But cash isn't an asset. It is optionality fuel. It gives you the option and opportunity to take advantage of, of other opportunities, I guess. So it puts you in a position to capitalize on those opportunities, which is a position of power, but it's not an asset in and of itself, except for on a balance sheet. So if we are holding cash, we need to be aware, again, of inflation. So when it's coming back, inflation cuts into the growth potential of an asset because the value of the underlying dollar or whatever fiat currency you're using is going down. Thus, the real return is offset by inflation. So all of our assets are actually mostly going up because of inflation, because the denominator that they're measured against, the dollar, is just going down in value. So the real skill here is honestly figuring out which asset is going up because it's actually gaining value, because that is the one that's actually going to potentially produce the multiplier effect. You're not just keeping pace with inflation and basically replacing what, the purchasing power that you are losing due to inflation, but you're actually now, putting in, taking one step, but getting 10 paces further. You're getting some leverage on that, is my point. So in order to outperform, you must prioritize assets that are growing more than inflation. That is another reason why we look at that CAGR metric as well. If your CAGR is bigger than whatever the yearly inflation rate is, you could use CPI, you could use true inflation, then you actually have a real return. And you can see here, I have put in a few of these things and measured them against their real return versus nominal return. And you can see that for the most part, the big assets that we spoke about, like they will give you some return. The real return, however, of bonds is negative. So, that is just for right now, by the way. It's probably not always going to be like that. And it definitely hasn't been that way in the past, but it is negative. Real estate, if it's residential, will probably be negative, or close to negative, or just close to break even. And even if we go to the, SPX index, your rate of return, for your nominal return is gonna be like 10, 12%, but your real return due to inflation is gonna be like 4.5% maybe. And again, Bitcoin's gonna be much less as well when you account for that. But even if that number is positive for the real return, now we're actually beating inflation. Now we're actually accreting in value. Now we're actually getting more without working more. That is the key. That is leverage. So not only do all of these things add up, but there's also tax advantages of holding assets. And we need to understand, again, the tax code here, just a little bit of the tax code, because once you understand that, you understand how the system is really set up. Earned income, that is the income that you earn from, having a job, being an employee. That is taxed the highest, up to 37%. federal, that is. Of course, you can incur even more tax with, with your state tax. If you're self-employed, at another fucking over 15%. No deductions or income stops if you stop, again, like it's tethered to your work. If you stop working at your job at Microsoft tomorrow, they're going to stop paying you, or at least maybe get a severance, but you know what I mean? Like your income, your potential goes to zero. And then on the other hand, assets are taxed the least. So you have the most optionality with these things. And the tax code is really there to help reduce your tax liability for owning assets. What the government is really trying to do is they're trying to give you incentives to invest in things that they want entrepreneurs to go and take care of. So, for example, real estate is a great example of an asset class that has very, very preferable tax code structures. You are given all sorts of tax breaks and everything for being an entrepreneur in that sector. Why is that? Because the government wants to promote people to take risk, to go ahead and provide housing for others, because that helps just in general. And of course, it's a very risky thing. So that is also why you do get those tax breaks for, again, investing in those assets. But again, if you're just working and you're getting an income, you're paying a shit ton of tax. That's just the way that it is. I'm not saying it's fair. I'm not saying that I like it, but that is the way that it is. And that is why assets must be prioritized over anything else. Any dollar that I earn outside of, about a year's worth of living expense, I just throw that into whatever asset I want to invest in at that time, typically traditional markets or perhaps some Bitcoins, these sorts of things. And of course, anything health related, I will always invest in. Now, let's do a little bit of a comparison here. Again, your tax rate, of course, it might not be exactly this high, but at the upper brackets, it certainly can be this high when you do add in state taxes as well. That could be anywhere between like 30 to 50% if you're a W-2 employee. Tax tools available? None. It's, you basically just get you basically just get handed your sort of tax sheet at the end of the year, and that's it. There ain't much you can do there. Passive? Hell no. Scalable? Also hell no. It's tied to your time. Freelancer? It's basically just a self-employed person. 30 to 50% as well. If you want some tax tools, they are available with an S corp, specifically LLC, less so. But again, passive, no. Scalable, not really. Business owner. Now you're starting to get some optimizations here. Tax rate can be anywhere from 0% to 30%. Again, you're going to get some write-offs. You're going to get deferrals. You're going to get income splits, all these sort of things. Passive could be. Scalable, well, hopefully. Real estate, 0 to 20%. Again, you're going to get a lot of help here. Depreciation tools, 1031 costs, segments, these sorts of things can be super, super useful. Again, the government wants to promote people to go ahead and take on the insane amount of risk, by the way, to provide this service. So it makes sense. They're going to provide that incentive by reducing your tax liabilities if you do things right. Could it be passive? Sure. Is it scalable? Kind of. Less so than other things. Stocks and crypto, your tax rate, somewhere between 0 to 20%. You have your long-term capital gains rate, so that's going to bring it down a little bit if you're holding things for a long time. Loss carryovers, can it be passive? Yeah, absolutely. Is it scalable? Absolutely. Digital products, again, this would be like you're selling stuff online, 10 to 30%. Again, optimize. You have corporate structures, royalty treatments, these sort of things, passive and scalable. So you can see these sort of the advantages there. Now, here's the thing, and what I'll end on. So you're probably watching this and you're like, okay, and let's say you're coming from the lower end of the spectrum here, which is completely fine. I was on the lower spectrum as well. It's very possible I go back to the lower spectrum over a long enough period of time. Who knows what the future does hold. But even if you're at the lowest level there in terms of financial position, assuming you at least have some income or some ability to produce income, you can employ this tactic. You can put all of your money into assets. Yes, your assets can go down in value. And yes, there will be some periods where that absolutely will 100% happen. Yes, you can invest in the wrong assets and lose everything or lose just a significant chunk in a very short amount of time. Absolutely. These are topics for another video. These are why you need to study whatever the hell you want to invest in, because that is, well, perhaps one of the most important parts. But you can put every dollar that you make or every euro that you make or whatever the hell you are making towards assets. And you actually don't even need to keep any money of your earned income in cash. What you can do, and what will be a big topic for a following video in this playlist, is how to leverage your assets and use asset-backed loans to essentially gain liquidity, gain cash without actually having to sell your assets. That means you buy your assets and then you get to continually hold them. Thus, they appreciate in value, assuming you chose the right ones. And you will, yes, have a loan, which means that you have to pay the interest on, but you can just pay the interest on that, use it as your sort of living expenses. And that allows you to continually hold these assets that are continuing to gain wealth while you spend that, less important or less valuable, I would say, cash as it continues to inflate away. That is the key here. Like I said, the game isn't rigged, or at least I really don't think the game is rigged. It's just hidden below thousands of pages of complicated legal shit explaining how the system works, which no one goes through the issue of doing. But of course, now that we have ChatGPT, it's become a lot easier, to be honest. But once you understand the system, you can play the same game. It's just a hidden game. Doesn't mean that it's rigged. Doesn't mean that it's unfair. I think it is fair because all that information is out there. It's just some people don't fucking know the information. Why don't they know the information? Well, I don't think that there's any excuses in today's day and age when we have access to the internet, and especially large language models that can help you with these sort of things, that are infinitely patient to walk you through it and give you examples of how to use these. But if you're still that person who doesn't want to do it, hey, this video isn't for you, man. Just keep on doing whatever the hell you're doing. And when you have enough pain, maybe, just maybe, come back to this video and you'll start to understand and maybe take action on these principles. Look, have you heard of Elon Musk? This is exactly what he does, by the way. Like, he almost, I mean, he didn't get into trouble doing this, but he was taking out so many loans backed with his Tesla stock that I think the shareholders of Tesla were like, okay, we need to put a cap on this. Like, this guy's borrowing way too fucking much money. But yeah, this is the same game that the rich play, that they are, usually taught from their own families, that just most regular people aren't taught. I was not taught this. My father wasn't taught this. It's not his fault. He didn't fucking know. He didn't have the internet. So yeah. Anyways, the difference is, like I said, you just didn't know the rules and you didn't know how to execute it. Now you do. And like I said, there'll be subsequent videos in the same playlist that will go over step-by-step instructions of how to exactly do this if you can't necessarily figure it out from this video. The system is set up for people to buy assets and then take on loans using those assets as collateral in order to access cash liquidity and live their day-to-day lives. And by the way, when you take out those loans, it's not earned income, so it doesn't get taxed. That cash that you get from an asset-backed loan is tax-free. I mean, it's fucking crazy. Like, when you actually start to learn the tax code, you realize that's just the way that we want the system to work. It's to promote people to promote people to invest in assets so that generally, assets go up. Like, it is kind of a Ponzi scheme, I guess, in a way, but I guess that is the sort of equity, as well, quite literally stocks are called equities, but that's the equity that you can have in the, I'm speaking from American perspective, but from the American market. Like, anyone could be a part of that. You don't need to invest hundreds of millions or have hundreds of millions to invest. You can invest $1. You can invest literally 1 cent into Bitcoin. And like I said, cash borrowed from loans does not count as earned income. Therefore, it is not taxed. You don't pay any tax on that. So for example, you might buy SPY, SPX, watch the stock appreciate and take out a loan that has a lower interest rate than the CAGR of SPY. So this is where things get a little more Jedi-like. This is where I really want to expand on a subsequent video later on, but here's the real game. You buy assets that appreciate, you take out loans versus, using that asset as collateral, and the interest rate on the loan that you are paying is, hopefully, if you do things right, going to be lower than the CAGR of the asset you own. Thus, as time goes on, the value that your asset is accruing over time is outpacing inflation outpacing. Well, I mean, it's great if it outpaces inflation as well, but most importantly, outpacing the interest rate from the loan that you took. Thus, that can just cover that money, and then there should be some left over as well. And if you're doing that, then you've really hit the jackpot. That's where you actually get to accelerate your sort of wealth building phase. And this is, again, the information that if I would have just known this even fucking 5, 10, 15 years ago, I mean, goddamn, my position would be much, much different. Look, I'm not unhappy right now, but of course, when you start to see the missed opportunities, you're like, oh shit, fucking goofed it up there. And of course, it's my fault. I just didn't know. Now I've spent the time to actually learn. And hopefully this has been useful to you as well. And like I said, there'll be a full in-depth tutorial of how to do this step by step in a following video in this playlist. It'll be along the lines of like, never sell and get a shit ton of cash, something like this, some clickbait bullshit. But I really want to make this video series relatable to people. I'm thinking of, honestly, my boxing trainer, Nico, when I create these videos, because I know that he kind of like understands these things a little bit, but he's not in the space, and he's a completely different life. But I want to make these videos for, I guess, a more general sort of audience, because this is really the game. This is the penultimate game, and if you can understand this, you're going to be in a good place over a long period of time. And the earlier that you learn it, the better. And I'll leave things right there, and I'll see you in the next one. Take care.